Okay. So how many of y'all were able to complete chapter 3? Okay, y'all still working on it. Do y'all have any questions about that? Because this chapter is going to kind of build a little bit on what we did last week. Anything specific that you want to go over before we get started? Okay. All right, so let's get started with chapter 4. Chapter 4, we're going to be talking about a merchandising business. So previously, we've been focusing on all the transactions that come into a business, using those documents to do analysis, get them into the computer, post them through a journal entry and putting them over to the accounts, and then putting together a financial statement. So we have all of our, transactions that are happening, and then the end is the reports we get at the end, talking about what our sales were, what were our expenses, what was our income for the year. Talked a little bit about the accounts, how we make adjustments to those accounts depending on what type of account it is, to keep our revenue and expenses matching, using that matching principle that we use in accounting, following the GAAP guidelines. Today, we're going to focus on a business that sells merchandise. So this is a product or goods, same thing, interchangeable, can be interchangeable how you use it. So a company is going to buy product and they're going to resell it. And there's two businesses that do that. There's wholesalers. So wholesalers may buy from the manufacturer, and that wholesaler is going to sell it wholesale to someone else, maybe not you. So maybe I'm a wholesaler and I sell projectors. So maybe I buy a bunch of projectors from Epson. Yes, that's an Epson. So let's say I buy a bunch of projectors and then I'm going to wholesale them to a reseller. Okay, that means I'm a wholesaler. I'm not going to pay tax on that inventory that I'm purchasing. I'm just through. Okay, I'm buying from the manufacturer and I'm selling to someone that's going to resell it. Then I have a retailer where I'm buying from the manufacturer or the wholesaler, and I'm the one that's selling directly to the consumer. Okay, so it's a little bit different, two different scenarios, but both have product that they're buying and selling. Okay, and that's what we're going to focus on tonight, is how do we record those transactions? What does that look like when we buy the equipment and when we sell the equipment? Okay, so net sales, this is something that you're going to hear. You need to know what these terms are, what they mean. Net sales, so that's just your sales, less any discounts or returns or allowances. Okay, it's just net of that. So not just what you sold, but you have to take into account, deduct what came back to me or what was defective, right? So that's net sales. Then we have cost of goods sold. A lot of times you'll see me just write COGS. So you have to write the whole thing out, cost of goods sold. So when you see that, that's what that means. So cost of goods sold, that means that I have goods that I've purchased and it's the cost associated with those goods. Those are the ones that were sold. Why it's called cost of goods sold. So it's my cost. It could be what I purchased it for plus transportation that it took or any preparation of that product in order for me to be able to get it ready to resell. That's my cost on that product. Then we have gross profit. So net sales, which is my sales less my discounts and allowances. That's going to give me net sales minus my cost of goods sold is going to give me my gross profit. So on the income statement that we've been looking at, we'll see revenues and then we'll see expenses. So this is going to change just a little bit depending on what type of financial statement we do or what type of income statement we use, because you may look at it a little bit different, a little more in detail. And you'll have something called the gross profit on there, where it's just going to be revenue, which is your sales, less your cost of goods, and get that number. Then there'll be another section that will deduct your operating expenses. So that will give you net income. Okay, so we're kind of chopping it up just a little bit. So we've talked about revenues less expenses is my net income. So now we're just kind of adding a little piece in there. We want to see our costs separately from the operating expenses, potentially. You don't have to do it that way. But typically, a company that sells goods will have a financial statement that's broken out. So your gross profit minus your operating expenses will give you your net income. Okay, so your income statement is going to be like in two sections.
You're saying income? Oh, okay, I don't know. Sorry.
Yeah, the last one is the gross profit. Gross profit is just the sales minus the cost of goods. It's your gross profit. It'll have a total, and then you'll have your operating expenses under that, and then you'll have your net income. So just be in two sections. It's just chopped a little bit. All right. So merchandisers will have new current assets on the balance sheet. Now I have products, I have goods. So my new current asset is going to be inventory on the balance sheet. It'll be in the current asset section. Okay, operating cycle. It begins when we purchase the merchandise for cash, and it ends when we're getting paid back cash for that merchandise that we sold. Okay, that's my cycle. We have two different inventory systems that we use to keep track of the inventory and how we calculate the cost. So there's different methods. We'll go into that a little bit more when we go through inventory methods, but I just want to mention these two now because you will learn both ways to calculate. I think it's next chapter that you're going to be calculating the cost of goods based on inventory going in and out. Okay, so we have one perpetual inventory system. A perpetual inventory system is going to keep track of all your purchases and sales as you go. Okay, so during the middle of the month, you can pull out what that cost is based on what you've purchased so far, what you've sold so far. Periodic inventory system is going to say, I want to look at it for a particular period of time, and it doesn't matter if I purchased and then I sold, and then I purchased and I sold. We're only looking at that end point. How many did I buy? How many did I sell? And then we calculate it that way. So we'll do a little bit more of the calculations next week. But there's two. So perpetual is keeping track as you go. And then we have periodic, which is at the end of the period. Okay, so merchandise purchases. So we're going to purchase product, and we can buy it with a cash discount or without a cash discount. I talked a little bit about this, that we can buy with a discount term, which is something that some manufacturers or some wholesalers may offer to you. They don't always offer it to you. They can be different. It doesn't always have to be the same. It allows the reseller or the wholesaler, whoever's buying that product and getting those terms, it allows them to have an opportunity, if you have the cash flow, to be able to save a couple of dollars. Okay, and you get that little discount, and that can be tracked a couple of different ways. So we'll talk about that too. So let's say we purchased $500 of product. We want to do a journal entry for that. So if I'm buying inventory and I'm buying it on credit, does that mean I'm spending cash now? No. So do you remember what that account is called? Accounts payable. It's a liability. I'm going to be liable to pay for that product in the future. What is a normal balance for a liability? A debit or a credit? A credit. And I'm receiving inventory. What type of account is an inventory? It's inventory. Asset. Yes, asset. And do we normally have a debit or a credit balance for an asset? A debit.
Debit.
When I buy inventory for $500, I'm going to put that on my books. My inventory on the shelf is going to be $500. That's going to be my debit. So I'm debit merchandising inventory or just inventory for 500. And I'm crediting because I'm buying it on credit, not cash. It's going to be accounts payable. Now, if I paid cash for this product, I would credit cash so that my cash is reduced. So now I have my asset set up and I have my liability set up. I got to pay this in the future. They're both increased. Even though one's a debit, one's a credit, they've both increased. You understand why? Yes, no, maybe? No?
No.
Okay, so the reason why I said they both increased is because an asset, when it increases, it's going to have a debit. That's my normal balance debit. So I've just bought $500 worth of, let's say, shoes. Those shoes are going to now go on my shelf, right? I've increased my inventory. I've increased my assets by that amount. Well, now I have something that I have to pay. I have a liability. I'm liable to pay in the future. What's a liability normal balance? A credit. So anytime I'm increasing my payables, it's increasing, that credit gets larger and larger. So it's carrying a normal credit balance. I'm now adding to my debt, right? Because I haven't paid for it yet. I have $500 in addition that I have to pay out in the future. So that liability is increasing just like my assets increasing. Hopefully that helps make sense. Okay, I messed up something here. Let me see. Okay, now we have a purchase with a cash discount. So I'm purchasing something from someone that's offering me an opportunity to save a little bit of money and get a discount if I make the payment within a particular period of time. So the format for that is 2/10. That means I get 2% if I pay in 10 days. And then N30 means net 30. It's due in 30 days. However, I have this opportunity to get 2% off if I pay it within 10 days. I'm sorry, I forgot to silence my phone. I didn't want it to go off. Okay. So I have $500 of product that I'm buying. So when I buy the merchandise, we're going to do the entry that we just did. Just like that, inventory and accounts payable, because we're going to pay for it in the future. So the first part stays the same. When I buy it, whether I have a discount or not, that entry stays the same. So I'll have inventory 500 and I'm going to have accounts payable 500. Okay, nothing changed yet. Now, if I decide that I'm going to pay for this within the 10 days of that purchase, I get to take 2%. So I figure out what that is. So it's simple. You just take the 500 times 0.02 to get what your discount is. Our discount is going to be $10. So this can vary. Maybe I'll have to look and see how the homework wants you to do it. But depending on the company you work for, they may just reduce inventory by that price, or they may have a separate account to keep track of how much are they taking in discounts. And it's a separate account that will show them how much at the end of the period or a period of time, like a quarter, depending on what you want. You can run it and look at it and see how much money am I saving by paying this off, and paying this within this shorter period of time and taking advantage of that discount. If you have the cash flow, this could be beneficial. So we used to do it at the AV company that I worked for, because a lot of their manufacturers would give us those types of discounts, and we would put it in a separate account, and at the year end, you can look at it and it adds up. Okay, so when I pay for it, I need to cancel out the entire payable that's on my books. I have a payable of $500. So I know I need to get rid of that. How am I going to get rid of this? By doing it less the discount or the whole amount? I want to get rid of it completely.
The whole amount.
The whole amount. So I have to debit accounts payable. So this is my payment for $500. And it's because I'm paying off all of it. I don't want to show on my books that I still owe someone $10 when I don't. Okay, so I need to take the whole thing off. Because it helps if I put the whole account description. Okay, and then we're gonna have cash going out. How much is the cash? It's not 500, right? We're gonna take advantage of the discount. So we're gonna keep the $10. So our cash going out is $490. So let's just go to inventory. I have to look at the homework and see how it does it. So we're reducing the cost of that inventory by $10 because we didn't pay 500, we paid 490. So we reduce the cost, or it could be purchase discount that goes to an account that's keeping track separately of how much your discounts are on purchases. Okay, does that make sense so far? Okay, we're paying the whole thing off, so we want to clear the entire liability because now we want to take off of our books that liability we're showing. We'll take the whole thing off. So that number doesn't change. You just take the whole $500, take it off or whatever it is. And then the cash is always the cash that you're paying out. And then you're left with the difference. And I'll make sure I tell you where I want the difference to go if I ask you a question like that on the test. Okay. All right, so then we have returns and allowances. Sometimes when we purchase equipment, we may not keep everything. Maybe something happened, we ordered 10 projectors, but we only needed 5, so we're going to return 5, but within the limit, we can return those. And we're basically just going to get them off the book. Sometimes you have an allowance of some sort because maybe there's some damage and you decided to keep it, and you can discount your inventory. So let's say that we've decided that we're going to return $250 of that $500 purchase. We haven't paid for it yet. So we brought it in on the books. We had inventory 500. We have our payables for 500, but now we're returning $250. So if I'm returning $250, I'm getting rid of some of my inventory. Well, if I've just increased my inventory, I've added to my inventory, I've added to my shoe stock of $500 on the shelf. Now I'm taking it off. Well, I'm removing some of my asset. I need to decrease my asset. So I'm going to have to do a credit for that inventory, right? I'm adding to, which means I'm debiting on the asset side. If I'm taking away, I need to credit. So I know my credit side is going to be to inventory $250 because I'm going to be giving those back. Now, I have a payable on the books, a liability for $500. I also need to decrease that because I don't want to show that I owe them $500. If I return that product, I only want to pay them $250, right? So how do I reduce a liability? Anybody want to guess? You probably know. You know, debit, yeah. So we're going to do a debit to accounts payable for $250. We're going to credit the inventory for $250 because we've returned that. Okay, so now on my books, I'm only showing I owe Epson $250 for the projector, right? And then I show on my books that I have $250 worth of inventory because I've reduced it. All right, so the transportation cost, sometimes you will add the price of what was shipped to the cost of the inventory. Sometimes you won't, depending on how you've made the arrangements with whoever you're buying it from. You have 2 options in the transportation costs. One's FOB shipping point and one is FOB destination. So the shipping point is when it transfers title, when it leaves the shipping point. Okay, so that should help you. FOB shipping point, when it's leaving the shipping point, it's no longer their product. So let's say Alfini is sending me a bunch of shoes. It's on the dock, it ships. I'm responsible for the cost now of that shipment coming in of shoes, not them. So it left their shipping point, and then that cost is now transferred to me. I'm the buyer. So I'm the one that's gonna be paying for that cost. Okay. So if I paid $1,000 for the shoes and then the shipping's $50, I would add that 50 to it. Okay. And then it would be $1,050 for the cost of the shoes. If it's FOB destination, the title is going to transfer once it gets to its destination. So title transfers at destination point, which means all through the shipping process, that cost belongs to the person that's selling the product. So I don't pick up that cost. Whoever I'm buying from is picking up that cost. Okay. So now let's, that's the purchasing side. Let's look at the sales side. Do you have any questions about the purchasing side?
Ready cash.
It's coming out. Were you trying to ask a question? Okay. So on the sales side, we're going to look at sales that we're selling to our clients, customers. We're going to have discounts, maybe returns and allowances, and the cost of goods that we sold. So we just bought inventory. Now we have inventory to sell. So when we sell that product, it's going to be for a set sales price. Sometimes you give them a discount if they pay within a period of time. So just like you can have an opportunity to save a little money with a discount, you can also offer that to your customers. Sometimes they have people that take advantage of that, and you'll have to know how to record those entries. Then we have returns and allowances. So you don't always buy something and never return anything, right? Sometimes you have to bring something back for whatever reason. And so you'll have some returns that are coming back, and you'll have to put that inventory back on the shelf, back on your books. Okay, so we have to make sure that we know how to record both sides of selling the product for the sales price and also removing it for what we paid for it, our cost. Okay, so there's two sides whenever you have a sale of a product. So we've talked a little bit about services, and maybe I sold my services for accounting for tax season, and all I have to do is record the sale of $1,000 for tax services. That's my sale, and I'm recording cash or an accounts receivable to collect that later. When you have product, you have two parts to that, because there's now product, and the product is not being sold, at least hopefully it's not, or you won't make any money, for the same price that you purchased. So you have to find a way to record both entries. So there's going to be 4 pieces to a sale. Okay, so let's walk through that. Let's say we have product that we sell. Let's sell it for $1,000. And the cost of that product that we paid for is $800. So we got to figure out how we're going to record all of that. Let's say we sell to a customer on credit. They're buying on credit, which means we're not getting cash. So do you remember what kind of account that is? If we haven't collected yet, but we need to find a way to get them on the books to make sure we can collect from them in the future. Do you remember what that account is called?
Accounts receivable.
Accounts receivable. We're going to receive money from someone on that, that account in the future. So we have accounts receivable as our asset account, right? So we're debiting $1,000. I'm selling it to them for $1,000. So I want to make sure I record what they owe me later is the $1,000. My sale of that product is $1,000. So I have some sort of revenue account. If it's, shoes, maybe shoe sales. It could be just revenue, whatever you choose to call that account. Some kind of revenue account is going to be credited. Remember, whenever we have revenue, that's a credit. Okay. So that's the first part of it. The second part is the cost. So remember, I have inventory and I have cost. And in order to show on my financial statement, my income statement, a reduction in that sale price, I have to put that cost in. So if my sale is a credit and I want to offset that, I have to have a debit to my cost. So I'm gonna debit my cost of goods sold account for the $800. Okay, I'm recording the cost. And I also need to remove the inventory. How do I remove the asset? How do I decrease my asset? With a credit. So my inventory is being reduced. I'm crediting my inventory by $800. So you see there's 4 pieces, 2 journal entries. Okay, so I recorded my sale. I have my revenue right here on my books. I have money I'm going to collect in the future right here. It's an asset. And then I have my cost of goods sold, which is going to reduce my sale to show what my profit is. And I've also reduced my inventory because that inventory has now left the building. So I have to reduce it with the credit. If I have a discount that I'm offering someone, that would be a contra revenue account. So remember in depreciation, we talked about a contra asset account. We don't go back and put any entries directly in that asset that we bought. Like, let's say it's equipment. I have equipment on my books and I need to depreciate it over time. I called it a contra asset account. It's an asset account, but it's doing the opposite of what normally happens. It's reducing that inventory. I mean, that equipment. So it's 2 separate accounts and it's giving me a net book value. Same thing with a discount. We will use a contra revenue account. So instead of the discount going as a credit, we may use a sales account, call it the sales discount, and it's going to be a debit. Okay, I just wanted to mention that real quick. So if we return product, and like, let's say we have the sale of this $1,000. Let's say what's being returned. Somebody's returning, let's say 200. And the cost of it is, let's say $75. So some of the product that I just sold $1,000. The product cost was $800. Now they're coming back and they're returning some of that, returning $200. So I have to get that back on the books. Well, I also have to reduce my revenue, right? Because I no longer have a sale for that. And I also need to put that cost back on the books, put my, get it off the books because I didn't sell it, and get my inventory back on the books because now I have product coming back. So I want to, let's look at the sales part of it first. So what the customer is getting back is $200. So I'm going to debit my returns and allowances. That's my contra revenue account that we just talked about. The debit for the whole amount that they are getting, $200. Now I need to also reduce their receivable because I'm showing they have an accounts receivable for $1,000. They're no longer going to owe me $1,000 if they return the 200. So I'm going to credit the accounts receivable account $200. So now they only owe me $800. Okay, the other side of that is my cost of my inventory. I'm bringing inventory back. I'm adding to my inventory stock, so I'm increasing my inventory. I have to debit inventory for $75. And I'm going to credit cost of goods sold $75. So I'm reducing my cost as well, because initially I said my cost was $800, but I've taken some product back. So it's no longer that $800, it's $75. That's $75 less because I just took that back. So does that make sense, having to understand that you have a sales side going on where you're either collecting cash, have your accounts receivable, you're recording your sale on the books, and then you also have your product cost. What did you pay for it? I need to recognize that cost. I need to pull that inventory out of my balance on the books. So I have to have that part too. The return, same thing. You have the 2 journal entries to make sure that you have the cost and the sale recognized. Do y'all have any questions on that?
No.
Okay. So our financial statements. So on the income statement, we're going to include now cost of goods sold, right? We talked a little bit about that in the beginning. We're going to add that cost of goods sold on the statement. Depending on what kind of statement it is how it shows up. And we also going to have gross profit if we do that multi-step income statement. Also on the balance sheet, we now have a new current asset, which is our inventory. Okay, inventory sometimes can be converted to cash pretty easily. Not all the time. Sometimes you have products, especially if you're a technology company, you could potentially have product that's obsolete and hard to get rid of. So that might not be very easy to convert to cash. But normally, inventory is considered a liquid asset, and you would put it under your accounts receivable. Okay. All right, so the financial statement format, we have a multi-step income statement. This is what I was talking about, how it's kind of chopped. It shows you your inventory and your cost with your gross profit, and then it'll show all your expenses, your operating expenses, and then your net income. Okay, that's the multi-step. Let me see if I can give you an example of what that looks like. Okay, so you see how it lists out sales, and it's got less your sales, discounts, returns, and then it's got net sales. Less your cost of goods sold gives you your gross profit. Then it lists all your operating expenses. And at the end will be your net income. So that would be a multi-step. Okay, that's your 3 main parts. Then your single step, it's just going to list that cost of goods sold as another expense and subtract from the total to get your net income. So here's your revenues. It's just giving you the net sales. It's not giving you the breakdown of what the sales were, less the discounts, less the returns. It's just showing me my net sales. And then I have total revenue. I have my expenses listed out. Cost of goods sold is now part of my expenses. It's not listed separately. And I include my operating expenses with it, so the end is net income. Okay, and then we have the classified balance sheet where the inventory is listed as a current asset. So you see it's right there under the accounts receivable. That's usually where it's at. Cash is usually always first. It's most liquid, obviously, it's cash. Okay. And then we have 2 ratios. We have the asset ratio. That's their ability to pay the current liabilities. So it's quick assets over current liabilities. The quick assets, they are only cash, short-term investments, and receivables. That's all that's included in your quick assets. And then you have your current liabilities. So I think it was last week, we had the current ratio. And I just kind of noted that's a little bit different because the asset ratio, it gets rid of the less liquid assets. Okay, so you're not going to have inventory in there. It's not going to just be your current assets. It's only the cash, the investments in the accounts receivable on this one. And then we have the gross margin ratio. Just seeing if we're making enough profit. You can compare this year over year or, you know, quarter over quarter. And that one is net sales minus the cost of goods sold divided by your net sales. Okay, so something else I want to mention. When you're purchasing inventory, in order to be able to calculate the cost of goods sold or cost that's a product available for sale, this little formula here is going to help you. You can fill in the numbers that you have and kind of reorganize and solve. Like if you needed ending inventory, you can solve it just this way. But if you wanted to know what your cost of goods were, then you could put those numbers in and kind of rearrange them to come up with that number. So beginning inventory, so that's going to be given to you. Normally you'll have the beginning inventory. It'll tell you what your purchases are. So I'm starting with a certain amount of stock on the shelf. And then I'm going to be making purchases through that period. Okay, so I'm adding to. That's what's available to sale during that period of time. So my purchases are added to my beginning inventory. That's my cost available for sale. Okay, beginning inventory plus purchases equals cost available for sale. Less cost of goods sold. So out of what's available, I'm going to sell some of that and I'll have costs associated with whatever was sold. So I need to deduct those costs. And once I deduct those costs, I'm left with my ending inventory. So that's going to be helpful. Okay, so let's look at some of the homework and go through it. See, this is kind of in the way. Okay, so let's look at the first one. It says use the following information in random order. I don't know if this is going to blow up. Here we go. From a merchandising company and from a service company. So we're looking at two different companies, right? One has product, one doesn't. One's a service company. Okay, so it says to compute the available goods available for sale. So remember we just talked about how to calculate that. So it's telling me under the merchandising company that I have beginning inventory of 8,500. So we have to take the 8,500 and we have to add what? What's getting added to my beginning inventory? For Kleiner Merchandising Company.
The depreciation?
The net purchases?
Yes, the purchases. So we have our beginning inventory plus purchases. So everything that we've purchased is going to get added to the beginning inventory. So it's the 8,500 plus the 9,500. So my cost of goods available for sale should be 18,000, and it is. So there's the 18,000. Okay, then it wants to know what the cost of goods sold are. So we need to look to see what else we have. We have ending inventory, but it doesn't tell me what my cost of goods is. Yeah.
Your margin kind of confused.
Okay, we can back up.
Okay.
All right, so see how it says, I don't know if it's gonna let me write. It's not gonna let me write on it. Let me see. Right here. I don't know if that annotation is I don't know how to get rid of it. Maybe, I don't know. We'll see. Okay, so that section is what we're looking at. We're looking at the company that's the merchandising company.
Okay.
And they want to know what are the goods available for sale. So I need to look at it and see, okay, how can I figure out what is available for me to sell? Well, I'm looking for inventory because that's what I'm selling, inventory in this type of business. So I need to look for beginning inventory because I need to know what's available, not what I sold yet, just what's available. Well, I have all that beginning inventory that's available to me to sell, right? And then I'm making purchases throughout that period of time, and that's also going to be available to sell. So if I add those two together, that tells me what's available, a total of 18,000. So I'm taking beginning inventory of the 8,500 and I'm adding right here, my net purchases, 9,500. That's how I came up with my cost available for sale. So now the formula that we just did, in order for me to find my ending inventory, in order for me to find this, normally I would subtract my cost of goods sold, but does it list cost of goods sold in that schedule there? It doesn't. What does it give me? It gives me ending inventory. So I know this number. My ending inventory is 4,500. I also know my formula is cost of goods available for sale less cost of goods sold is my ending inventory. It's what's left. Well, all I have to do is take what's left and subtract it from what was available, and that gives me what I sold. So it's the 18,000 less the 4,500. So I'm filling in this number here. So the difference between the 18,000 and the 4,500 is the 13,500. So I backed into it. So as long as you know the formula, you can back into it if you know the pieces. Okay, then it says, I want to know the gross profit. Well, how did we say to calculate gross profit? Gross profit, if you think about the multi-step income statement, remember it had sales, less allowances, returns, and I had net sales, less my cost gives me my gross profit. Okay, so I'm not looking at any expenses. I'm just looking for the cost of goods and deducting that from my net sales. So it tells me net sales are 16,500. I just calculated my cost of goods sold. So I'm going to subtract the 13,500 and I have $3,000. So let me see if I can figure out now how to, I don't know how to, here. Nope, I'm kind of, oh, there we go. I figured it was going to be like an overlay on top. So here's my gross profit of $3,000. Okay, so it's the sales, net sales. Maybe the problem won't have just net sales. Maybe it'll say sales. It'll also give you returns and it'll give you discounts. So you'll know that you have to deduct those from your sales to come up with your net sales. Okay, this already gives you net sales. So you want to look for that especially on a test, to make sure that you have all your numbers. Know what net sales are and your net purchases, just the net after you take those discounts out. Okay, so we have calculated what was available to sell. And then we knew the ending inventory, so we were able to back into what my costs were of the inventory that I sold. And now that I know what my sales are and my cost of goods, I can figure out my gross profit. Okay. So next it says use the above information from a service company and from the merchandising company to compute the net income. So they want me to calculate net income on both. So the net income for, let's see who they're asking for first. They're asking for Krug. Krug's the service company. So how do we calculate net income?
Revenues and expenses, I think.
Yes, we have to take revenues less the expenses. I want to draw. See if it'll just let me. Okay, so we're going to do revenue of 21,000 less my expenses 8,100. So 21,000 less the expenses of 8,100. It's going to give me the 12,900. Let's keep going back and forth. Okay, so that's a service company. Then we have Kleiner, which we just calculated the gross profit, which was 3,000. Let's see. Let me just verify that. It was 3,000.
Now for the gross profit,
Mm-hmm.
didn't you say that we just subtract those available for sale minus cost of goods sold?
Right. Well, you take, yeah, you have
I
your,
did that and then my answer was incorrect.
okay. So you have to take your purchases plus your beginning inventory to come up with what's available. Then deduct your ending inventory to calculate the cost of goods sold.
Got that.
Okay. So once you have the cost of goods sold, then you take whatever the revenue number is or your sales number. It says net sales on Kleiner. So take your net sales less your cost of goods sold.
Oh, okay. So
And that will give you your gross profit. Okay, so ours was 3,000. And the expenses on Kleiner here are 1,800. I keep writing all over this thing. Okay, so my net income for them is 1,200 because I'm taking the 3,000 that we calculated, which is the gross profit, and I'm deducting the expenses. So my net income is 1,200. Okay, do y'all have any questions on that one?
yeah. So the gross profit that we're using to figure out the net income for Kleiner merchandising is the same, like it's 36, mine's 3,600.
Yeah, that was what you calculated out for your cost of goods. I mean, that was your gross profit, 3,600. Yeah, so that is what you use to deduct your expenses.
Use that number and then you deduct expenses.
So yeah, you're looking,
400.
yeah, and then you deduct that, and then the difference is what your net income is. So for the merchandising company, you're looking at your net sales less your cost of goods. So think about that multi-step income statement. That first part is your net sales minus your cost of goods gives you your gross profit, and then less your expenses gives you your net income.
Confusing, but yeah.
Yep. So just remember that cost of goods on the multi-step income statement and what they're looking for here. In order to get that gross profit, you're only taking sales minus cost of goods. So you don't get to net income until you have expenses that are being deducted. Okay, so if this question just said, what's the net income? You would have to go through all the work to figure it out, but know that when it says net income, you have to deduct those expenses. Okay, the expenses would not come into play if they're just looking for gross profit.
Okay, and then another question is, how are we figuring out single numbers from two companies?
You're looking at them separately. It's two different, it's almost like doing two different questions in one. They're just giving you two separate companies. They have different numbers, but you're calculating them a little bit different because one's a merchandising company. And that's why you had to do that first part to come up with what your cost of goods sold was, what your gross profit was, because you're only looking at sales and costs at that point with your inventory. Once you get to that point, then you can deduct your expenses. The other one, you don't have all that work because there is no inventory.
Right, okay.
You're just doing revenue less expense. That's my net income. Okay, so net income comes into play when you have your expenses. Okay, so number 4, we're going to prepare journal entries to record each of the following transactions of a merchandising company. The company's using perpetual inventory system and the gross method. Okay, so we're recording as we go. So on November 5th, we purchased 800 units of product at a cost of $8 per unit. So we're going to have to calculate that out, right? It's telling me 800 units at $8. All right, the term of the sale are 5, 10, net 60. So that means we're having them give us an opportunity to take a discount. 5% if we pay within 10 days, or it's due in 60 days. The invoice is dated November 5th. So let's record that first. So it's telling me, let me move this so you can't, well, it won't go down anymore. Okay, so we have 800 units times $8. Okay, that's how we calculate what we purchased. $6,400 is what we spent on the product. Okay, so I'm bringing inventory in. It's an asset. I have to debit inventory for that amount of money. Purchasing 800 units times 8, 6,400. So I'm debiting inventory for $6,400. Now it tells me that I have terms. So I didn't spend cash. So right now I'm setting up a liability account. I'm liable to pay in the future. So that's my account what? Accounts payable. That's my credit, $6,400. So I'm putting it on the books. That's what I'm going to owe them. So in the real world, what'll happen is you'll have a source document, which is probably a purchase order that went with inventory department. Inventory department received the product. It's checked for cost and quantity. So now you have a purchase order with a receiving document that goes up to accounts payable and accounting. Okay, so you have your inventory department that's receiving all your inventory. Those bills have certain documents that have to go with it. So you like to make sure that whoever's in inventory is checking to make sure the cost is correct and the amount is correct, the quantity. Once you have all those documentations turned into accounting, then accounts payable position normally is the one that matches that to an invoice that you receive. That document gets entered into the accounting software. When you're entering it in the accounting software, you're not doing a journal entry like we're doing here. A lot of times it's just, okay, I'm going to put the vendor name, what's the date on the invoice, what are my terms? I'll make sure I select this correct terms, which is 4%, 5%, 10. I would make sure I select that. Put 800 in at $8 for this particular quantity. A lot of times the inventory is all broken out. You have to select which one it is. And then it gives you the total of 6,400. Sometimes there's shipping, sometimes there's not, depending. In this case, we don't have shipping. So my total invoice is $6,400, and I submit it probably into a batch. I'm putting a bunch of invoices in accounts payable. At the end of the day, I post that batch. So then all of those invoices have gone into the system. And once the batch is posted, it brings everything over to my general ledger, and I can see all of the postings. Okay, that's what normally would happen instead of just doing a journal entry like that. Okay, but I want you to understand that when you're doing that and you're putting it in, you're putting that inventory into the system at that point. So if my inventory manager runs a report, now he's looking, he can see everything that should match the shelf. Periodically, there's counts where we check to make sure those are correct. We do reconciles. Okay, that's kind of the process. And then for the payable side, I have that on my books for the full amount, because what if I don't pay it within the terms? I have to pay the whole thing. So that's why it's recorded when I buy it for the whole amount.
What does the N60 mean after the,
Net 60. Net 60 means that I have 60 days to pay the invoice. Okay, and I pay the full amount at that point.
That has nothing to do with the 5% over 10 days.
Right, that's only if I don't pay it within the 10 days. If I pay it within 10 days, I can save 5%.
But otherwise,
Otherwise, you pay the whole thing in
the standard rate would be over 60 days.
Standard rate would be paying in 60 days. On November 7th, we returned 25 defective units from November 5th, and we receive a full credit. Well, how much do we pay for them? And we times that by 25, so we get $200. Right, that's my credit, because I'm returning and getting full credit. Now, my accounts payable is going to decrease, and my inventory is going to decrease. Okay, so I'm doing a decrease in those accounts, which means I'm doing the opposite of their normal balance. Right, the inventory is going out, which means I'm going to have to credit it. It's no longer part of the inventory that I have available to sell, so I have to reduce that by crediting inventory. I also have to reduce my liability by the $200. So I'm debiting accounts payable. So now when I go to pay them, do I owe $6,400 on the books anymore? No. When I run my report and I see that I owe XYZ, it's not going to be $6,400 anymore. It's going to be $6,200. Okay, because I put that $200 in the system as a credit. On November 15th, we pay the amount. So since we're paying it within the 10 days, do we get to take the discount? Are we taking the discount on $6,400 or $6,200? 62. We only get the discount on what we actually purchased. We return the $200. So now we do 5% of the $6,200. So my discount's $310. Okay, so when I make my payments, I'm not spending $6,200. My cash out of pocket is $6,200 less that $310. So my cash going out is only going to be $58.90. We're going to debit payables for how much? Accounts payable on the books had how much on it?
64.
It had 62. Remember, we returned. So my full amount that I owe is $6,200. So when I need to remove that, what's coming off the books? A debit to accounts payable for $6,200, whole thing. My cash going out, the credit, is it going to be the whole $6,200? No. Okay. So We have debit to accounts payable for 6,200. A credit to cash for the money that's going out, which is 58.90. And then we have a credit to merchandising inventory for $310. That's my discount. And like I said, the books do an inventory in this example, but a lot of businesses will keep track of that separately so they can see how much of they're saving in those discounts they're taking throughout the year. Okay, so we purchased inventory, we returned some of the inventory, and we paid it and took a discount. So now we have inventory. Now we haven't done anything with sales. All we've did is bought inventory, paid for it. Okay, we have it on hand, ready to go. Six. So let's look at 6. So we want to prepare journal entries to record each of the following sales transactions for merchandising company. The company uses perpetual inventory system. Okay, on April 1, we sell merchandise for $7,000 with credit terms net 30. Invoice date is April 1, and the cost of the merchandise is $4,200. So we're selling product now. Okay, so we've already bought inventory. We figured out how to put that on the books. Now we're going to sell it. It's telling me that the sales price is $7,000 and the cost is $4,200. We're selling it on credit, so I know I'm not getting cash, and it's net 30. So net 30, there's no discount, right? So they're going to have to pay the full amount when they pay. So we're going to have 2 entries. Let's record the sale first. Okay, so we are having them purchase $7,000 on credit. I'm debiting accounts receivable for $7,000. My credit is what? What am I recording at that point? I'm putting on the books that they owe me $7,000. $7,000 is what I sold the merchandise for. So what's the credit go to?
Inventory.
What account? It's not going to be return. We're selling the equipment. So what are we crediting?
The inventory?
Not yet. Because we're just looking at the sales part of it right now. We're not looking at the cost yet. We will eventually have to credit our inventory. But for right now, we're trying to record what?
Sales?
Yeah, sales.
Okay.
The sales. So we're recording our sales, our revenue for the full amount that we sold it for. So debit accounts receivable, credit sales, $7,000. Second part of that is now we have to remove our inventory for the cost, which is $4,200. So we're going to debit what? But we're recording our cost, which is, what's the account called? Cost of goods sold. We're going to debit that for the cost, which is $4,200. And we're crediting what?
Merchandise.
Merchandise inventory. There we go. So that's our sale. All right, so on April 4th, the customer in the April 1 sale returns $780 of merchandise for a full credit. $780 is going to be the credit to them. Okay, the cost to us is $468. Okay, so we have to fix both. We have to fix what they owe us in the accounts receivable. We have to reduce our sales. And then we also have to put the inventory back on the books It's saying that it's returned to inventory. So there's nothing wrong with it. They're just returning it. So we have to put it back into the inventory and we have to reduce our costs because it's no longer a cost, right? Because we got it back. So first part, we have a customer that owes us money. So that's accounts receivable. So I have to reduce that, which means that's going to be my credit side. And I also have to reduce my sales. But remember, we're not going to go right back to sales. What did I say we have to go to? It's a contra revenue account. Do you remember? Well, what they doing? They're returning something. So what's that account called? What's the sale contra account? So we have a sale, then we have a contra account, which is offsetting sales, and it's a return. Sales returns and allowances. So we're going to debit sales returns and allowances for that $780 because that's what they're getting the credit for. We're going to reduce their account because I don't want to show that they owe me that full $7,000, right? I want to reduce it. So I have to give a credit on their account. So their accounts receivable will be $780 credit. Again, you confused?
I'm confused because the $780 was on April 4th, but you showed it on,
Yeah, it's April 4th. They're saying that it was returned from the April 1 sale. So you made the sale on April 1. So it's just referencing that. On April, you bought it on the 1st, on the 4th, you're bringing it back to me and I have to give you a credit. Okay, so on April 4th, now I'm issuing a credit. So if this was something, some kind of transaction actually happening and I'm putting it into the computer system, what happens when you get a credit? Normally they give you a receipt, right? When you go, you return product, they'll do whatever they do on the cash register or the computer and they give you a receipt back. So what's happening is the clerk or whoever it is that's entering that is entering a credit on that particular receipt number or that particular customer. It's going to be identified to that first sale that happened. Okay, and let's say I didn't pay for it on credit card like you do at Home Depot. Let's say I bought something on account. I'm at a supply house. Maybe I work for an AC company and I'm buying some product to go fix somebody's AC. When I walk in and I buy something, they give you a receipt. Maybe my customer number is 100. When I go back in with a return, they'll take that product back. They'll enter it in the computer. And for customer 100 on their end, they're going to give a credit. So you'll get a receipt back that has the credit memo. In the end, customer 100 is going to show the net, not that whole 7,000 anymore. It'll be the 7,000 less the 780. So not an actual journal entry, but this is what's happening in the computer. Okay, so then what else happens on the 4th? So I've returned the product for the sale amount. I've given the customer a credit. I've recognized it as a return. So now I have my cost side. That merchandise is coming back in to go back on my shelf. So what am I debiting?
468.
Yep, inventory 468. And I'm crediting what?
Inventory.
No, inventory is what I'm debiting for 468. What am I crediting? Yeah, you want to make sure you don't do that. If you do a journal entry, don't do inventory and inventory. If you don't know, anyway, maybe get part of it right. But okay, so what was that?
The cash?
No, not giving cash back. It's part of my cost. So initially when I sold that product, when I removed the inventory, what was the debit? Cost of goods sold, because I sold it. Now it's coming back. So what has to happen? I got to reduce my cost because now it's no longer a cost of something that I sold because it came back.
Gotcha.
So I have to credit costs, $468. On April 8th, sold merchandise for $3,000. Credit terms, 110. So I have 1% if paid within 10 days. Net 30. Invoices dated April 8th. Cost of the merchandise is $2,100. So now I'm doing the same exact thing that I did on the first one. I am selling product. So I have my sales price and I have my costs. So when I sell the merchandise on credit, I'm going to debit accounts receivable, $3,000. Credit sales, $3,000. That takes care of my sales side. I have to record the cost of the inventory going out, which is $2,100. So cost of goods sold is my debit for $2,100. And I'm crediting inventory. Inventory is leaving for $2,100. April 11th, received payment for the amount due from the April 1 sale, less the return on April 4th. I'm receiving payment. Did they have a discount? That first sale that I had was how much?
$7,000.
It was $7,000. They returned how much? $780. So the net is $62.20 is what they owe me. They have no discount. Their terms were net 30. So how much cash am I getting? The whole thing, right? Cash coming in is going to be a debit for $62.20. And what's the credit? Do you know what the credit side is? I'm receiving cash and I have to remove what that's on my books. Something's on my books that I have to get rid of.
A receivable.
So receivable, yes. So I have a receivable right now for customer 100, right? The receivable is $62.20. I need to get that off the books because they no longer owe me any money. So my receivables. Okay, so here's my cash, $62.20, and my credit for accounts receivable, $62.20.
What did you do again to get the?
Okay, so they initially purchased $7,000 worth of merchandise, but they returned 780 of it. So you have to deduct that from the 7,000. Okay, now it doesn't go into the payment for the last one. On April 8th, we sold $3,000 and their terms were 1% 10. Let's say we get payment for that too within 10 days. So let's just say what that entry would be. So if they have $3,000, they get 1% discount. The discount's $30. So I'm not going to receive the whole 3,000, right? I'm going to receive $29.70. So my cash coming in would be $29.70. I should have probably did this first. Okay. So let's just say April 12th, we get payment for number 6. We're getting payment for, I can't, sorry. It's this one, the $3,000. Okay, so we take the $3,000 times the 1% to get the $30. That's the discount that we're giving them. So cash received, that's my debit, $29.70. And then I can't fit it. I know that I need to remove my accounts receivable for the whole thing, which is $3,000. So if I just had cash of $29.70 and I have my accounts receivable as a credit for $3,000, they're not in balance, right? So I know that I've taken this discount, so I need to put it to some sort of discount account. it would be a debit. Maybe to like sales discounts. It's a contra account for the $30. So I'll have a debit to cash for $29.70. That's the money I'm receiving. Then I have my debit to the sales discount, which is a contra asset account, right? It offsets my sales for the $30, and then credit accounts receivable for the full amount to get rid of it off the books, $3,000. I wonder what that is. People start running, we'll go.
Yeah.
Okay. So this would just want you to fill in the missing amounts. And it's got an income statement format. It's listing out sales. So all of the ones that are in blue, when you bring up your homework, those will be blank. And you're going to have to calculate to get into that. So let's look at this first column. Sales, 66,000. Our cost of goods sold. So we have inventory, beginning inventory, 8,900. Purchases, 39,000. This would be blank. I have my cost of goods sold, 33. Gross profits blank. My expenses are 10,000, and then my income is going to be blank. All right, so I need to figure out how to calculate those numbers, right? So let's see. So I start with my beginning inventory, 8,900. Let me put it in here and make sure I come back into the right thing. Make sure I'm telling you correct. Okay, so we have beginning inventory of 8,900. I need to add my purchases, 39,000. That gives me available. Doesn't have that line on here to know what's available, but you know that beginning balance plus purchases gives me what's available. So what's available is 47,009. It tells me how much I sold, but it wants to know what the ending is. Well, how do I get to the end? I take what's available less the cost of goods sold. Remember, I gave you that little formula that we went over earlier. So I have 8,900 plus 39,000, which is 47,900. Deduct the ending inventory. I mean, not the ending inventory, sorry, because you don't have that. Deduct the cost of goods sold, 33,900. That gives me 14,000. That's where the ending inventory comes from. Okay, so it's a little bit out of order from the way I gave it to you, but you should be able to manipulate the numbers. I'll show you.
I'm not really following.
Okay. So we have 8,900. That's my beginning inventory. My purchases. So that's 39,000. Add those together. Forgot what it was. 47 what? 47,000? Was it 39 plus 8? No. 47,900. All right. Now I have to deduct cost of goods sold to get ending inventory. What's my cost of goods sold? 33,900. So when I deduct the 33,900 from the 47,900, I get 14,000.
Okay, so my
That's-
numbers are different.
Right.
So I'm adding my cost of merchandise purchases to the beginning inventory.
Yes.
How do you do that better?
Beginning inventory plus purchases gives you what's available. Less your cost of goods gives you your ending inventory.
Less the cost of goods. That's what I mean.
Less cost of goods equals ending inventory. So in this case, they gave us the cost of goods, so you just went right into it. The next one, they don't, yeah, they do. They give you both. They don't give you purchases. You have to back into that number.
Is this formula in the chapter 4 PowerPoint or Word document?
It was on the,
I know it's gonna be on the Zoom thing, but,
I don't-
on
on the
PowerPoint,
document.
yeah, the document, that should be in there.
I don't remember if it listed out that way. It may be, but I don't remember if I saw it on there specifically. So it's purchases plus, beginning inventory plus purchases equals cost of goods available.
That's the gross profit one.
Mhm.
I got the beginning inventory plus purchases
Right. That gives you what's available.
equals,
And then that's it. Okay, so that beginning inventory plus purchases equals what's available, cost of goods available to sell.
the cost of, wait. Say what equals again?
Cost of goods available for sale. And then you want to deduct your cost of goods sold to come up with your ending inventory. Okay,
Deduct what?
cost of goods sold, just put COGS, cost of goods sold, and that gives you your ending inventory. Okay, you need that cost of goods sold when calculating your gross profit. Okay, because that's going to be revenue, your net sales, less the cost of goods. It's going to give you that gross profit. So we haven't gotten that far yet. We just went through the inventory and what was the cost and what was the ending inventory. Okay, so next it's saying, what is my gross profit? So we know the cost of goods sold and we know the sales. So you take the 66,000 less the cost of goods sold, which is 33,900. Okay, that's 32,100. That's my gross profit. It tells me my expenses are 10,000. So I need to deduct the expenses in order to come up with the net income. That's where the 22,100 comes from. So the gross profit less expenses equals the 22,100, which is net income. So that was the first one. So basically each one of these is just a little bit different. You just maneuvering the numbers around the way you need to solve them algebraically in order to come up with the number that you need. As long as you know the formula, you can back into it. Okay, you're gonna have a couple of different formulas to know. All right, so B, we have sales 44,600. And then we have beginning inventory of 16,990. It doesn't give purchases. And then you have your ending inventory at 2,900 and your cost of goods at 20,000. So normally we have the beginning inventory plus purchases, which we don't know, which gives me what's available, less my cost of goods sold, which gives me my ending inventory. So I know ending inventory is 2,900. I know my cost of goods was 20,000. So how do I figure out what the purchases were? So if my ending inventory is 2,900 and I know my cost of goods sold was 20,000. If I add those two together, those two ending numbers, I know what was available, right? Because what's left over and what I sold is what I had available. So if I add those two numbers together, I can come up with what was available. Well, if you add them together, you get the 22,900. My beginning inventory was 16,900, so I have to deduct that from what was available in order to figure out what I purchased. Oh, I didn't have the right numbers when I did it in the calculator. 16,990.
I just did that in my reverse and it said it's wrong. So I'm clearly not doing it right. So you're saying to figure out the total cost of merchandise purchases?
Well, you have to know what's available. in order to be able to deduct out what the beginning inventory was, in order to figure out what the purchases were. So you have to know what was available. So it gives you two numbers that you can come up with that. You can take what you have left over on the shelf and what you sold. So you add those two together. So you just kind of back it into it in reverse.
2601.
Plus your cost of goods sold.
That's, I was doing the inventory beginning. Oh, I know, it was this one. Okay.
Okay, so once you have those two numbers added together, you know what was available. So you see what I did was I just took these two numbers, add together to get available. Okay, once you know, this is where your available goes right here in this section right here. So it's beginning inventory plus purchases is available.
Okay.
So you can back into it. Ending inventory plus your cost of goods equals available. Once you know what's available for sale, then just take out your beginning inventory and the difference is what you purchased. So you should take ending inventory plus cost of goods sold less beginning inventory. And that gives you your purchases. Okay, so we want to find gross profit. Gross profit is what?
Net sales minus cost of goods sold.
Correct. So we have the 44.6 minus the cost of goods. And that gives me my gross profit. Back out the expenses to get net income, which is 14,290. Now, they didn't ask for the net income, but that's how they got it, right? Take your gross profit less your expenses, and that gives you net income. Do y'all want to do one more like that? Okay, let's do C. So we have beginning inventory of 5,900. We have purchases, which we don't know. That gives me my available. And then it says we have ending inventory. Yes, so my ending inventory is, you got to do a little bit more finagling. Let's see, ending inventory is 8,200. So all I have is beginning inventory. I have ending inventory. I don't have purchases and I don't have cost of goods sold. So I have to go a little bit further. Okay, so my gross profit equals 4,600. How do we calculate gross profit? Sales minus cost of goods sold equals gross profit. I know my sales and I know my gross profit. So now I can figure out my cost of goods sold. So I'm not figuring it out from the inventory side first. I have to go to the sales and the gross profit to be able to calculate. So now I have sales of 47,000 less the cost of goods sold. So I don't know what it is because it doesn't give it to you, equals 4,600. Okay, and then you just, you know, you got to subtract in order to get the answer. So the 47 less the 4,600. Is that what it was? 4,600 is my gross profit. So 42.4. Okay, so now I calculated my cost of goods sold and I can put this in over here. Now I can do what I just did in B. I can add ending inventory plus cost of goods sold to get my available and then deduct out the beginning inventory. So I have $8,200 plus 42.4 gives me 50,600 available, less the 5,900. So my purchases are 44.7.
Total cost of merchandise purchases. You take your cost of goods sold.
Uh-huh. Plus your ending inventory, that gives you your available. And then you deduct out the beginning inventory and you can come up with your purchases, just like we just did on the other one. So that one was a little bit tricky because we had to figure out cost of goods sold first.
My numbers are 47,700 for my cost of goods sold. And then merchandising inventory ending is 8,800.
What was your cost of goods sold?
47,700.
Okay, and your ending inventory. So that gives you a total of 56.5. And then what was your beginning inventory?
5,000. So minus 5,000.
No, so your purchases should be 51.5 because you have to deduct that from what was available. Take the beginning inventory and deduct what was available and you should get the 51.5. Is that the number?
Yeah, that is right.
Okay. Okay, so that really wasn't like an exercise to really know what's happening journal entry wise, but that exercise is trying to get you to understand how the numbers flow together, how to come up with those numbers. What do you need in order to get this? What do you need in order to get that? Okay. All right, let's look at 13. The following list includes selected permanent accounts and all of the temporary accounts from the December 31, 2018 unadjusted trial balance of Amico Company. So they use the perpetual inventory system and it's saying unadjusted. So we know we're going to have some kind of adjustments first before we put the closing entries. Okay, so we talked about the closing entries last chapter and how we want to get the expenses and revenues off the books at the end of the period in order to go into the new period and start fresh, where you're looking to see what is my expenses, what are my revenues, how much money am I making this year or the last year, right? So we have to close all of those temporary accounts. Remember talking about that? So we're going to walk through that in this example. So we're given the unadjusted trial balance. So we have to make an adjusting entry, which is what we did last chapter. Accrued salaries amount to $1,500. Prepaid selling expenses of $3,300 have expired. A physical count of year-end merchandise inventory shows 29.6 of goods still available. Okay. So let's look at the first one. We accrue salaries of $1,500. So we have salaries for people that worked, but we haven't paid them yet. So we have to accrue that. I want to recognize that expense in the period in which it happened. So we're going to put on December 31, salaries expense, $1,500 to record the expense. We haven't paid it yet, right? But we know that they've worked. So we want to record the expense. Salaries expense, $1,500. We also going to pay them, we're liable to pay. So salaries payable, $1,500. That's what's going to roll over to the new year, the payable. Okay, the expense is going to get cleared out. Right now on the books, it shows salary expense of $51,000. Well, I just did an adjusting entry. So I know that that balance is changing, right? Because I just added an additional $1,500 to it. So I know that that's going to be one of my balances coming forward to the closing entry. I have to make sure I have my correct expense. So I know salaries expense is going to be the 51,000 plus the 1,500. Okay, so that's going to be 52. Oops, wrote it backwards. 52.5. All right, so we're just going to keep that there for right now. All right, then it says prepaid selling expenses of $3,300 have expired. I'm looking here now at this account, prepaid selling expenses. I had on the books $5,900. So remember, when we were doing the adjusting entries, when we prepay something, we have that as an asset on the books because we've already paid for it. And then over time, we use that expense, right? And we record the expense in that month, in that period, and we reduce that prepaid. So that's what we need to do in this adjusting entry. We need to adjust what that balance needs to be. So it's telling me 3,300 has expired. So it's not saying what the ending balance should be. It's just telling me how much we've used. So we had 5,900 of the prepaid, 5,900 less the 3,300. So I'm going to have a new ending balance in that account too, because it's telling me I've already used 3,300 of the prepaid. When I reduce that prepaid, if prepaid is an asset, in order to reduce it, I have to do a credit. My debit is the expense. So let's look at the journal entry. Selling expenses, 3,300. Prepaid selling expenses, 3,300. So my balance in that prepaid account is reduced by the 3,300. So I'm going to put 5,900 less 3,300 to come up with my balance, 2,600. I'm just kind of keeping track of the adjustments as we go. Okay. You can do the journal entries first and then go back and do that if you want. All right. Next, it says a physical count of year-end merchandise shows 29.6 of goods still available. So when I do my count, what's left is 29.6. If that doesn't match what's in my inventory, I have to make an adjustment. Let's find merchandising inventory right here. It says I have 31.5. Well, that's not correct. I just did a count. The count's not 31.5. It's 29.6. So I need to adjust 1,900. So I need to reduce the inventory by the 1,900. So cost of goods sold is where I'm going to capture the cost of that merchandise that is lost or whatever happened on why I have that discrepancy, but I need to reconcile it to what I actually have. So I'm going to reduce my costs. I'm going to increase my costs because those products are gone, and I'm going to reduce my inventory. So my entry on December 31, cost of goods sold, 1,900, merchandising inventory, 1,900. And what did it say that my merchandising inventory needed to be? Inventory is now going to be 29.6. So these are my new balances here for these accounts, those three that we just did adjustments for. Now I'm ready to do my closing entries because I know my new balances after those adjustments. We talked about the account called income summary. And the income summary is what everything flows into when we do the entries. So I need to remove revenue. Let's start with the revenue. It says I have sales of 541,000. I have sales returns and allowances of 18,1, so I have to deduct that from the 541. And then I have sales discounts of 5,300. So my net sales is 516. It's not doing it that way. Okay, you don't have to calculate it. You're gonna just do them individual. Sales is a credit on the books, so we're gonna debit the sales for 541,000 to remove them. It's gonna go to the income summary. The income summary is just a hold in place to bring into retained earnings at the end. Okay, then we also have to remove all of the expenses. Expenses are on the books as a what? A debit or a credit? Expenses are on there as a debit. So if I need to remove them, I'm going to credit each one of those expenses. So we have the prepaid selling expense. It was 5,900, but remember we made an adjusting entry and that balance changed to 2,600. It doesn't show it that way though, does it? Oh, I'm sorry. We're just gonna record the, we only taken off the selling expense. Wait, let me see. It's this one, hang on. It's gonna be these. And it's gonna be these. Okay. Go back. All right, so we have the two groups. We have the sales and then we have the expenses. Sales is coming off by itself. Then we're gonna calculate this number. But when you start putting them in, I wouldn't try to figure it out unless you do it on paper separately, but go through and put all your credits in first and wipe off those balances. So we have our sales returns and allowances. That's coming right from up here, the 18,1. Then we have our sales discounts, 5,300. Okay, see how they're crediting all those off. We have our cost of goods sold, 218,000. Salaries expense, remember we did the adjustment. So the salaries expense should be the 52.5, which we calculated after the adjustment. We have utilities expense, 16.5, selling expenses. We have to change that one because we had prepaid, that was 5,900, we reduced it. The debit went to selling expenses. So we have to add 3,300 to 37.5. Do you remember us making that adjustment, 3,300? So selling expenses can be 40,008. Okay, so 37.5 plus the 3,300. And then we have the administration expenses, 108. Add all those up. The offset to that is the income summary. Okay, let's look at this one. Okay. So income summary had two numbers. It had a credit of the 541 for the sales and it had a debit of 461.1 for the expenses. So if you take the difference of that, it's the 79.9. It would have been sitting as a credit, so we have to debit to get rid of it and then credit retained earnings. Remember, retained earnings captures each year. It captures what your profit was, your net income, or your loss. Okay, so we want to roll it into retained earnings, clear off your sales and expenses. We've adjusted the balances on the asset. And you'll be ready to go into the new year. Now, they also had dividends on the list up here. So we had dividends for 36,000. So we also want to get rid of those. Dividends is sitting as a debit on the account because it reduces your net income. So we're going to credit to get rid of it, 36,000, and then it's also going to roll into retained earnings. That's the portion of your net income that was paid out to the shareholders. So let me do this real quick. This salaries expense was 51,000. We made the adjustment of 3,300 from the prepaid, and it's going to get added here. Okay. That was the ones that I had. So here's the formula that I was giving you. This bottom part, if you go back, that's it right there. The test next week will cover chapters 1 through 4. And I'll put a study guide up on Moodle to kind of help guide you on what to study. So it's a lot that can come out of all the chapters. So I want to try to get potential problems that you're going to have to work out, you know, numbers, and then also what kind of journal entries you'll be expected to do, format, because it'll be different from the homework. It won't be, the questions won't be as complicated as the homework because of time and just the amount of information that's going to be on the test. So, let me get to, let's do, I'm going to give you an example of the review just so that we can go over it a little bit. So it'll look like this, or I might put this one up. I don't know if I'm going to change it or not. I might change the information slightly. So it'll look something like this.
That's what this is gonna look.
Something, yeah, something like this. This is like an example. It may be a little bit different depending on what we've gone over in class. And because this is just an example of a test review that I had put up for another semester. So it's always a little bit different, but this gives you an example. So it's just like this first question. Scott Company has total equity at the beginning of the year, 5,100. There are no stock issuances during the year. The company has net income of 7,500, pays dividend of 1,000. What's the ending equity balance? So you'll have to know that equity formula that we went over. Fill the missing number, total assets, total liabilities, total equity. So you know your formula, asset equals liability plus owner's equity, you can back into it. The homework problems that we did during this semester of this one, the format was slightly different because we weren't using Connect. So the questions tend to change a little bit on how they've been presented on Connect is different than that one. So the way I word it might be a little different. But the test that I put up for y'all will be what I expect you to know for the test. So we have an income statement, revenue, supplies, expense, net income. So you would have to go in and just find those numbers, put them in. Know how to calculate retained earnings. Balance sheet format will be the assets on one side, liabilities and equity on the other side. So
Did you say there was gonna be a review or?
yeah, I'm gonna have a review up on Moodle. I'll put like something like this. It'll have the questions that you can go through and know what you need to study and the kind of problems I want you to know.
So this is gonna be the review?
Well, I don't know if it's gonna be this specific one. This is just an example. It'll probably be a little bit different. It's gonna be based on, you know, the way that we've asked on homework. I want to try to stick to what I've done for homework, what I've covered in class. I don't want to put anything new. And so each semester is a little bit different. So it'll be a little bit tailored to y'all. Okay, then you remember we did T accounts and we had to list out the T accounts and come up with a balance in an account. This is an example of how potentially I could ask you how to do that. So I may only say, you know, give me a T account for cash, and then you'll go through the transactions and you'll look for cash.
Are some questions worth more points than others? Or they all worth-
I do that. I'll try to probably make the majority of them about the same, but then you'll have some problems too. I haven't made it up yet, but I'll send an email and let you know before Tuesday, once it's done.
And if we need any more help before Tuesday?
So I do have a guy on Moodle that does tutoring, and then I guess just email me like what you're struggling with. Maybe I can try to get a response back to you to help.
I mean, I know a lot of it, but now I'm looking at this, I'm like, I'm gonna fail this. You know, because it's out of my head already.
Right. But I want you to focus on the review sheet more so than the homeworks. And every problem that I give you on the review may not be on the test, but it could be different versions of the test. You don't know what you're going to get on there. So you want to make sure to know how to work all the problems that are on the review, because some of those are going to pop up. There may be a little slight change or different numbers, but you should know how to solve it by knowing how to do the review. I know it's a lot of information, so I try to help like give a review to make sure, you know, and those that study and have done the homeworks usually do okay. And then depending on, you know, every class is different. So depending on how it goes, we may have an extra credit assignment if we need it. You know, we'll kind of see how we go as we get through the semester, what we need to try to give opportunity if there's a particular area that most students are studying with, I'll kind of focus on that and do an exercise or a project on that particular thing to try to give you more practice with it and get points too. It depends. It really depends on how everybody does. I have, if I had to. Sometimes I don't, believe it or not. So this is the format for the journal entries. You don't have to write debit or credit. I just want you to you know how whenever we do the homework, it's got the debit and then the credits indented a little bit. So when you do a journal entry, I want you to do the same format, okay? This is, we could have entries on adjustments for the prepaid expenses. We went over adjustments last week. I know chapter 1 and 2, it's been, I mean, we had 2-week break in between. So that's like, you know, next week, we're at 6-7 weeks out. You know, it's been 6 weeks since you saw that first chapter. So I'll put a lot of that had some terms and had the matching principle and, you know, cost principle. And so there's some assumptions. I'll put that on the study guide to make you, you know, go back and kind of refresh on those things. Okay.
And you were saying something about a YouTube video. Did you post a YouTube video?
I have the YouTube videos up for chapters 1 through 3,
Okay.
and I'm recording this one. So I'll put this video up as well. So you'll have all 4 on
Oh,
YouTube.
so these lectures.
Yes.
Okay.
Yeah, so you can go back and find parts where we talked about something to refresh.
I knew about that.
Yeah, and so this is net sales, looking for net sales, net income, gross profit. So know how to calculate those, what numbers you're looking for to come up with those. Purchase with discount. So know how to do a journal entry or how to calculate what the discount would be. If you had that on there, how would you do a journal entry when you purchase equipment?
How many questions on the test?
Don't know yet. This is a simple multi-step statement. Just got your sales, less your sales discounts, returns and allowances to equal your net sales. So if I wanted to, you know, I may give you a list like this and kind of break this out for you. You have to plug in the numbers. There'll be some multiple choice. I'll put the maybe a journal entry on there and you'll have to circle which one's correct instead of having to write it out. I've done that. Sometimes I'm just looking for you to make a calculation like we just did in the homework, where I may give you beginning inventory, purchases, ending inventory, and you have to know how to calculate that cost of goods sold. But I'll make the test first, then I do the review, and then I post the review up to help guide where to study, kind of questions to look for. No Scantron, have to be in class in order to take the test. So try to get here next week. And then, you know, you'll have the whole class period probably till about, I would say most people are done between 7:30 and 8, usually at 7:30 we're done. So we won't do a class after. I have in the schedule rotated things around a little bit. We'll do 2 chapters at the end when I do less of what's in the chapter. So we'll be able to go home after we take the test next week. A lot of people like to do that.
Right.
So hopefully not, hopefully not. Hopefully you'll get there by Tuesday. just email me. Let me know.